Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hemoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve, let's kick things off with a pretty dramatic story coming out of Southern Ontario. A home that was purchased for $835,000 back in 2022 has just sold for a staggering 70% less this month.
That's right, Sandy. We're talking about a property on Carlton Street in downtown St. Catharines. The home was actually gutted by fire in December 2024, which is a major factor in the significant drop in price. Originally, it was a multi-unit home that had been listed several times since 2018.
It's interesting to note, Steve, that this property had quite a history even before the fire. It was advertised as an income property with 3 separate units back in 2020. Then it was converted into a rooming house with 10 occupied bedrooms by 2023. That flexibility should have made it appealing, right?
Yes, you'd think so. In fact, the property was bringing in $72,000 a year in rent. However, despite that income, it struggled to find a buyer after it was listed for sale in August 2022. And then, of course, the fire happened, which complicated matters significantly.
It seems like the owners were really trying to make the property work for them, but sometimes the market and circumstances just don't align. They initially listed it for $799,000 in June 2022, which later dropped to $770,000 by June 2023. But it just sat on the market until January 2025.
Absolutely, Sandy. By June 2025, they had to make a drastic decision and relisted it for $299,900. It finally sold this month for $257,000. So, even with the income potential, the fire damage was a deal breaker for many.
And it's not clear how much the owners might have recovered from insurance? Real estate commentator Shazi Goli noted on X that the owners faced a 70% loss, which is about $578,000. That's quite a hit, but hopefully, insurance covered some of that loss.
Indeed, Sandy. This case really highlights the risks involved in real estate investments. While properties can generate significant income, unforeseen events like a fire can drastically affect their value and marketability. It's a reminder of the importance of having a comprehensive insurance plan and a diversified investment strategy.
Steve, let's talk about the recent trends in Ontario's rental market. It seems like rents are continuing to drop across the province, reaching some of the lowest levels we've seen in years. It's quite a shift from the constant upward trend we were seeing before.
That's right, Sandy. According to a new report from Urbanation and Rentals.ca, asking rents in Canada decreased by 3.2% in September compared to last year's record high. This is the 12th consecutive month of year-over-year declines, which is quite significant.
It's fascinating, Steve. The average rent is now $2,123, which is also 1.2% lower than 2 years ago. This marks the first 2-year decline since January 2022. It seems like a combination of factors is driving this trend.
Absolutely, Sandy. The report mentions several factors contributing to this decline, including record-high apartment completions, a decrease in population for non-permanent residents, and a weakening job market. These elements are creating a perfect storm for falling rent prices.
And while Toronto remains one of the most expensive places to live in Canada, the typical one-bedroom apartment has dropped to around $2,295, and a 2-bedroom is now $2,941. That's a drop of 5.1% and 7% respectively from last year.
Yes, and it's not just Toronto. We're seeing marked decreases in rent prices across various Ontario locales like Ajax, Oakville, Etobicoke, and many others. Vaughan, for instance, saw a 10.6% drop for one-bedroom units, and East York experienced an 11.9% decrease.
It's definitely a renter's market right now, Steve. But interestingly, university towns like Windsor and Kingston are seeing increases in rent prices. In Kingston, for example, the rent for a one-bedroom apartment rose by 17.8% year over year.
That's true, Sandy. These areas are likely seeing demand from students, which could be driving up prices. In Greater Sudbury, the rent for a two-bedroom unit surged by 16.7%. It shows how localized factors can have a significant impact on rental markets.
It's a complex situation, Steve. For those looking to rent, it's a great time to find a deal outside major student hubs. But for property owners trying to rent out or sell, it might be a challenging period.
Exactly, Sandy. The current market conditions are creating opportunities and challenges depending on where you stand as a renter or property owner. It's important for everyone to stay informed and adapt to these changes.
Steve, with the recent drop in the Bank of Canada's interest rate, there's been a surge of interest in variable rate mortgages. More homeowners are curious about whether now is the time to switch from their fixed rate plans. What are you seeing in the market?
That's spot on, Sandy. With the Bank of Canada dropping the rate to 2.5%, many homeowners are evaluating their options. There's a notable increase in inquiries about variable rates. Some experts, like Nick Lecuyer from Mortgage Wellness, have observed a 30% jump in people considering switching to variable rates.
It's a significant shift, especially after the economic turbulence we've seen in recent years. Variable rates can indeed be appealing when there's an expectation of further rate cuts. Historically, borrowers with variable rates benefited when rates were low or declining, paying more towards the principal and less on interest.
Exactly. However, it's crucial to remember that variable rates are essentially a bet on future rate movements. Ron Butler, a Toronto mortgage broker, highlighted this, saying that while variable rates often won out from 2009 to 2022, the landscape might be changing. The fixed rate offers the certainty of a stable payment, which many find comforting amid economic uncertainty.
And that certainty can be quite reassuring. During the rate hikes in 2022, many variable rate holders found themselves paying significantly more each month, which led to financial stress for some. It's understandable why many are cautious now.
True, Sandy. Nick Lecuyer points out that while interest in variable rates is rising, the actual financial benefit might be limited unless we see more rate cuts over the next year or so. He suggests that the potential savings might only be around 0.5%, which isn't much unless you're certain rates will continue to fall.
So it seems like for those who are risk averse, sticking with a fixed rate might be the safer choice. Lecuyer also mentions that a 3-year fixed rate under 4% is currently a sweet spot, offering security and a reasonable rate.
Yes, and with the Royal Bank of Canada posting a 5-year fixed rate at 4.62% and a 5-year variable at 4.23%, the differences aren't as large as they once were. It's important for homeowners to weigh the pros and cons carefully.
Definitely, Steve. The decision between fixed and variable rates should align with one's financial situation and comfort with risk. With the Bank of Canada's next rate decision coming up, homeowners should stay informed and consult with mortgage professionals to make the best choice for their circumstances. Steve, let's dive into the challenges faced by borrowers who took out short-term mortgages in 2023. With renewals looming, many are facing tough decisions as they navigate this changing financial landscape.
That's right, Sandy. The focus has largely been on those 5-year mortgages from the COVID era, but there's another group of borrowers who took 3-year terms in 2023, hoping for lower borrowing costs down the line. They may find themselves in a bit of a bind now.
Exactly, Steve. While many who locked in during the pandemic enjoyed historically low rates, those who opted for shorter terms in 2023 have been dealing with higher rates and less time to build equity. It's a stark contrast in circumstances.
And with rates not dropping as much as some anticipated, Sarah Albert, a mortgage broker from New Brunswick, highlights that these clients are in a challenging position. They've had less time to pay down their debt and build equity compared to their 5-year counterparts.
Sarah Albert mentions the diversity in client situations. Some borrowers might not be able to refinance, but if they're just doing a straight switch, lenders are likely to compete fiercely to keep them. That makes it tough for brokers to offer something better, especially if there's been a change in the borrower's income or credit situation.
Absolutely, Sandy. For some borrowers who've struggled with payments, moving to another lender might be necessary. In some cases, alternative lending options could be the only solution if their current lender decides not to renew their mortgage.
It's a reminder that there's no one-size-fits-all solution here. As Albert pointed out, each client's circumstances are unique. Financial situations, family dynamics, and even employment types have evolved since the pandemic, making these renewals anything but straightforward.
That's a key point, Sandy. Many borrowers have seen changes in their household setups, like having elderly parents move in or adult children who haven't left home yet. These shifts affect housing needs and financial planning.
On a more positive note, some 5-year fixed-rate borrowers aren't experiencing the payment shock they feared, thanks to rate cuts starting in 2024. However, restructuring is often needed to make payments manageable, sometimes extending the mortgage term.
It's all about adapting to the current economic environment. Extending mortgage terms to 25 or 30 years is becoming more common to keep payments affordable. It's a balancing act between managing debt and maintaining financial stability.
Let's delve into the recent analysis from BMO Capital Markets, Steve. They've highlighted some troubling signs in the Canadian real estate market, suggesting it resembles the U.S. housing bubble that burst back in 2007.
That's right, Sandy. According to BMO, Canadian home prices have been on a decline for over 3 years now, similar to the trends we saw in the U.S. during their housing crisis. Robert Kavcic, a senior economist at BMO, has pointed out that while people are looking for bubbles in the equity market, the real estate market is already unraveling.
It's a sobering comparison, Steve. The report indicates that the correction we're seeing now is tracking similar patterns to Ontario's downturn in the 1990s and the U.S. housing crash. What's particularly concerning is the suggestion that this cycle will take years to resolve, not just months or quarters.
Indeed, Sandy. Kavcic emphasized that bubbles are usually only identified after the fact, once the market has corrected. In this case, the ongoing slump in home prices is seen as evidence of past excessive exuberance. Despite record population growth in 2022 and 2023, prices have continued to fall, which is quite telling.
And that's where it gets interesting, Steve. Even Canada's state-owned mortgage insurer has argued that this time is different, but BMO's analysis suggests otherwise. The current trajectory mirrors the U.S. crash, which could mean a prolonged recovery period unless something changes dramatically.
Exactly, Sandy. BMO also noted that the conditions which fueled the previous boom, like peak millennial demand, record immigration, and ultra-low interest rates, were a perfect storm that's unlikely to happen again soon. The bank warns that simply lowering interest rates won't bring back the market's glory days.
It's a challenging scenario for real estate investors, Steve. The idea that this downturn could spread beyond Ontario to other markets if they don't become more affordable is a real concern. BMO's perspective is that unless affordability improves, the market will continue to struggle.
Absolutely, Sandy. The report paints a picture of a market that needs to reset before it can stabilize. Until investment dynamics and affordability are restored, the bear market in housing is expected to persist. It's a stark reminder of the importance of cautious investing and realistic expectations.
Steve, let's delve into some insights from the Bank of Canada's Senior Deputy Governor, Carolyn Rogers. In a recent speech, she referred to Canada's banking system as an oligopoly, highlighting concerns about limited competition stifling growth.
That's quite a statement, Sandy. Rogers pointed out that the dominance of Canada's 6 biggest lenders, which hold over 90% of all banking assets, is a clear sign of this oligopoly. She argues that this concentration negatively impacts productivity, innovation, capital allocation, and consumer choice.
It's a significant concern, Steve. Rogers noted that While this concentration has provided some stability, it has also hindered productivity. She believes that more entrants and innovation could foster competition, benefiting consumers.
Absolutely, Sandy. Rogers highlighted the balance between stability and competition as crucial for economic growth. She mentioned that too much concentration can lead to inefficiencies, while too much competition might disrupt the market.
That's an interesting point, Steve. Rogers also mentioned the upcoming launch of real-time rail in 2026, which she believes will boost competition by allowing more firms access to the payment system. This could bring about significant efficiency gains.
Yes, Sandy. A study by the C.D. Howe Institute estimated these gains at $3 billion. Rogers also urged for the successful implementation of open banking, which would give individuals control over their financial data, further enhancing competition.
It's clear that Rogers is pushing for a more competitive landscape, Steve. She emphasized that both the public and private sectors share responsibility for productivity and economic growth. With the government set to unveil a new budget soon, it will be interesting to see their approach.
Indeed, Sandy. Rogers has been vocal about Canada's productivity issues before, calling it an emergency situation. She also acknowledged that while competition is essential, it needs to be balanced to avoid market disruptions, especially in sensitive areas like education and healthcare.
It's a delicate balance, Steve. The goal is to ensure enough competition to drive innovation and efficiency without causing instability. Rogers' insights certainly give us a lot to think about as we look at the future of Canada's banking and economic landscape. Steve, let's transition to some uplifting news from the real estate sector in Milton, Ontario. It seems that home prices there have experienced a significant increase recently.
That's correct, Sandy. Milton's average home price surged by 7.5% in September 2025, reaching $1,040,000. This is a notable rise of $72,076 from August 2025.
It's quite a remarkable increase, Steve, especially when considering the broader market trends. This uptick also marks a 1.4% increase compared to September 2024.
Exactly, Sandy. There were 132 home sales in Milton, with properties spending an average of 33 days on the market. It's interesting to see that while sales were up 3.9%, active listings increased by 31.7% compared to last year.
That's a significant jump in listings, Steve. It seems that detached houses in particular are driving this growth, with their average price hitting $1,340,000, up 9.4% from the previous month.
Yes, Sandy, and that's a 6.6% increase year over year for detached homes. This segment saw 59 sales, with properties averaging 35 days on the market. It's indicative of a robust demand for larger homes in the area.
It certainly is, Steve. However, not all segments are seeing similar growth. Semi-detached houses only saw a 1% increase month over month, and actually decreased by 3.1% year over year.
True, Sandy. Despite the slight monthly increase, semi-detached homes averaged $952,574, which is still a decline from last year. The market for these homes seems a bit more volatile.
And it seems attached houses and townhouse-style condos are also experiencing mixed results. Attached houses increased by 1.2% month over month, but dropped 7.1% year over year. Townhouse-style condos saw a 2.7% monthly rise, but a 10.2% decline from the previous year.
It really highlights the varied dynamics within the different housing segments, Sandy. Apartment-style condos, for instance, saw an 8.8% increase month over month, though they're still down 5.2% compared to last year.
It's a complex picture, Steve. Over the past decade, Milton has seen an overall increase in home prices by 86.3%, which is quite substantial. This includes significant gains across all housing types, reflecting a long-term upward trend despite recent fluctuations.
Absolutely, Sandy. These figures underscore the importance of understanding local market trends and conditions when making real estate decisions. The market's complexity means both challenges and opportunities for buyers and sellers alike.
Indeed, Steve. As always, it's crucial for those involved in the real estate market to stay informed and consult with professionals to navigate these ever-changing conditions effectively.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.